Hi, this segment of the Supply Chain Finance module is focused on the components of the financial statements, the income statement, and the balance sheet. Now keep in mind that for the firm there are many important financial statements. We've listed a handful of them here. Statement changes of financial position, the income statement, balance sheet. Several of these are included in the 10K, the annual report, etc., and so forth. In this segment, we're really going to be focusing on these two, the income statement and the balance sheet. Now, the income statement describes how the assets and liabilities are used during a particular period. You could also think of it as the sum of income-generating transactions, financial transactions, over a stated period of time. There are three primary components in an income statement. We have revenues, which is the money that you bring in. When you sell a product, you bring money in, all right? Next, you have expenses. When you, in the process of conducting business, the firm incurs expenses. That's producing the product and selling the product and all the administration. Those are called expenses. What's left over is the third item, which is the profit the firm generates. Now, I've listed a handful of things here I want to make note of. Revenues also goes by a number of different terms. Sometimes you'll hear it called turnover, sales, or proceeds. Profit also goes by different terms. You'll hear profit, but of course you might hear income, or there's different variants of profit: gross profit, net profit, EBIT, which stands for earnings before interest and tax, and then there's a number of other variations. When we think about expenses, there are many different components of the expenses. One of the primary ones you'll hear about is the cost of goods sold. Sometimes we call that COGS or COGS, right? You also have operating expense and then depreciation, then there's a number of others. Let's look at an income statement just to give you a view of what it looks like. Here we see revenue listed at the top. Now, why do we see it at the top? Well, this is one of the things you often will hear people refer to. What's the top line? So in that case, you want to know what's the total, what's the big picture? The big picture here is what we see is Intel is reported $55,870,000,000 in revenue. The cost of sales, that's a variant of one of the different costs, or cost of goods sold. And we see that that's $20,261,000,000. Next, we see gross margin. Well, that's a variant of the profit. It's one element of the profit, and we see that listed here at $35,609,000,000. Now, we see something else. There's a different kind of expense in here called marketing, general, and administrative. Sometimes you'll hear that as SG&A, or sales, general, and administrative costs. It's one of the different components of operating expenses. And then when you deduct all the operating expenses and all the other expenses, we get income before taxes. In Intel's case, in 2014, we see it was $15,801,000,000. And then the bottom line, what we refer to as the bottom line, is net income. What's left over after everything? You got $11,704,000,000. So we've seen an income statement. Let's talk about some of the components there. We've mentioned the cost of goods sold. The cost of goods sold represents the costs associated with the production of the particular products that were just sold, or services. As we see here, it says the direct cost attributable to the production of the goods sold by the company. Includes the cost of materials, includes labor, all right, used to produce the good. It does not include the indirect expenses such as distribution costs and sales force costs. Right? Sometimes this is also called the cost of sales. Now, sometimes we'll see a variant of that called the cost of revenue. And this is different from the cost of goods sold, or COGS, because the cost of revenue includes costs outside production, right, which is including the cost of distribution and marketing. So basically it's the total cost of manufacturing, which we were thinking about for COGS, but also delivering the product or service. I mentioned operating expense. One of the primary elements, we talked about this earlier, was sales, general, and administration. This includes the cost for your sales force, right? So you have a product, you produce it. Those are what the costs that are associated with that are the COGS. Now you got to sell it. Well, what are the costs associated with that? And that falls within SG&A, right? These are things that are not directly associated with the production of the product or the sale of the product. Okay, well, I should say G&A includes that, but SG&A includes the sales and the general administration. But generally speaking, these are these are expenses that are above and beyond the specific costs that are associated with the individual products themselves. Let's look at General Motors' income statement from 2014. We'll get a different view of this. Keep in mind that not every income statement looks exactly the same. They'll use different terms. They might be structured slightly differently, but they'll always have a revenue, a cost, and then a profit. Here we see what General Motors reports is they report the cost of revenue. Remember, we talked about that earlier. This includes the distribution cost. Perhaps they're thinking about that because they have distributors or dealers that they have to ship the products to. In this case, here they see selling general administrative, and Intel they had marketing general administrative. Now, let's talk about some of the other operating expense elements. Included in that are important elements known as depreciation and amortization. There are a handful of others, but for our purposes in the supply chain, we really need to be thinking about depreciation. That's the primary one we need to understand. But we'll talk about amortization here. Depreciation and amortization are non-cash expenses. You can say, well, what does that mean? Well, it means that it's a charge against the firm on the income statement that's in recognition of the depreciation or the lowering of the value associated with a particular asset. When we reduce the value of an asset, a capital asset, on our balance sheet, we take that as a period charge or a charge within a particular accounting period as an expense. So what we're really doing is we're really identifying the cost for the firm to actually use some of its capital equipment, and recognizing that while capital equipment has multi-year lives, they don't last forever. They'll last only a certain period of time. So depreciation is accounting for the reduction of a value of a physical asset. Amortization is slightly different. It's accounting for the reduction of the value of an intangible asset, specifically goodwill. Goodwill is the value that a firm that acquires another firm. It's the value, it's the amount that they pay over and above what the book value is of what they acquired. So if a company purchases another for, let's say Facebook paid $1 billion for Instagram, well, their book value was not $1 billion, considering they had only 11 employees and almost no assets, but they had intangible value to Facebook. So what we see there is that a large amount of that $1 billion that Facebook paid for would be considered goodwill because it's over and above the book value. Similarly, Facebook paid $19 billion for WhatsApp recently, and you can imagine similarly that a large amount of that is goodwill. Again, the amount over and above the book value of the acquired organization. Now, you also see research and development listed as an expense. That's not a critical focus for us in the supply chain, but of course that is included in what's often seen as an operating expense or considered an other operating expense. Now, the balance sheet is distinct from the income statement, and it's important to recognize that it represents the financial condition of the firm at one point in time. The income statement takes into consideration the performance of the firm over a period of time. Balance sheet, one point in time. It lists the assets, which are something that is owned by the firm and has measured value. It's the liabilities, which are a claim against the assets by other parties, right? Or you could think of these as debts or obligations that the firm has to pay other people. Assets always equal liabilities. This is what a tautology. That's the way it always is. The assets always equals liabilities. Now keep in mind, on the balance sheet, when recording value on there, what gets recorded is book value. And what's maintained on there is book value, not market value. Now, as we'll see in a separate segment, there are different methods for valuing inventory, such as LIFO and FIFO. So recognize that there are different methods of valuation, But keep in mind that we always use book value when we're recording the something in the journals. Now, it's possible that a book value could also equal the market value at a certain point in time, but the book value is what's maintained in the reports. Let's go back to Intel 2014, and we'll look at their balance sheet. We see the assets, and then we also see the liabilities. Oftentimes, we would see a balance sheet with the assets on the left side and the liabilities on the right side. In this case, we see the assets on top and liabilities on the bottom. But sometimes you'll hear that left side, right side. So with Intel, of course, we see the assets on top. And as I noted here, the liabilities are below that. Let's look just to be sure. What's the total assets we see in 2014? Well, $91,956,000,000. Total assets, total liabilities, $91,956,000,000. Yes, indeed, the assets do equal the liabilities, as we point out here. Let's look at the total current assets. This is another distinction in the balance sheet. We look at the current assets, and we also look at the current liabilities. This becomes important for the firm because the firm has to honor and meet its current liabilities. These are things that the company owes. And in order to do that, more often than not, they're going to do that with the current assets. Now, supply chain transactions affect both the income statement and the balance sheet. Let's take an example where a company sells a product for $10,000 in cash, and the product costs $2,000 to produce and deliver. How would this impact the income statement and balance sheet upon delivery? Now, keep in mind, before we go over the details, this is a gross simplification of the accounting transactions, which are not complete here. This is for general purposes, illustration purposes only. But you'll get the idea and understand how transactions the business undertakes, purchasing, selling, it ends up impacting the income statement and balance sheet. So, again, let's understand, how would this impact? Let's talk about first the income statement. Well, when a company sells a product, they generate revenue or sales, right? This is, they sold it for $10,000 cash, income goes up by $10,000. Sorry, excuse me, take that back. Revenue goes up by $10,000. Well, on the income statement, we also see that there's a cost associated with that. When the company sells something for $10,000, there's a cost associated with that. What was the cost? Well, we've identified that the product cost $2,000 to produce and deliver, so the cost would be recorded as $2,000. And then finally, on the income statement, net income would be reflected as an increasing at $8,000. Of course, $10,000 minus the $2,000 gives you the net change of $8,000. These are the income statement impacts. Let's talk about the balance sheet impacts. Well, because we've sold the product and we receive cash immediately, then our current asset of cash would increase by $10,000. Our inventory, or our current asset, would decrease by $2,000. Okay, so let's talk about this. Our current assets include cash and inventory, and one of those items, when we take it out, had a cost associated of $2,000. Well, that's what we take out, and that's what we redo. We remove that inventory, we remove that value of $2,000 out. So how does that affect now these are on the left side of the balance sheet, all right, the asset side. Well, the right side, or the liability side, has to equal the same thing. We see an increase of $8,000 here. Well, sure enough, retained earnings, or change in retained earnings, would be $8,000. Because there's a profit of $8,000, the net income, or the profit, shows up as a change in retained earnings. That's the right-hand side of the balance sheet, or the liability. So liabilities also includes owner's equity, or obligation to the owners of the firm. Okay? So we see that there are impacts on the income statement as well as on the balance sheet, and it all balances out. So we've been talking about assets. Let's talk about specific assets. Now, under current assets, I've already suggested some of the elements, but let's talk about what they are. Current assets are short-term in nature. They're intended to be liquid assets, meaning they can be quickly converted into cash within the next accounting period, which is often considered a 30-day period of the next month. Current assets includes accounts receivable, right? These are monies that are owed to the firm. Inventory, this is finished product and could be raw materials and finished work in process, as well as some other cash or cash-like items like marketable securities, and then another element which are prepaid expenses. We also see long-term assets, which includes plant, property, and equipment. Sometimes you'll see that referred to as PP&E. We'll also see some other fixed assets, and then we were talking about this earlier, goodwill. This is again the value, the amount over and above that which was paid for an asset, over and above the book value of that which was paid for an asset. Now keep in mind, I should have talked about this just a moment ago, but prepaid expenses are really an asset to the firm. It's expenses that we've already paid for, but for services and value that has not yet been delivered to the firm. Okay, so in a sense, we've prepaid for an expense, but we got something coming to the firm. Let's look at liabilities. Liabilities are basically obligations that current liabilities are obligations that need to be paid in the next accounting period. Again, we'll often think about that in the next 30 days. This is accounts payable. We have to pay our suppliers. Well, typically, you need to pay them within the next 30 days. Although that can be varied and modified based on the terms you agree with your suppliers. There are also things called accrued expenses. And this is the opposite, if you will, of prepaid expenses. Accrued expenses are expenses that the firm has accrued, but they have not yet paid out. So let's say, for an example, the firm pays its employees twice a month. Well, from the beginning of the month, from the first day of the month to the 15th of the month, the firm has not yet paid them. Yet the firm has an obligation to pay them. So what we do in that case is they accrue those expenses, and then those expenses are paid out at the middle of the month, right? This also includes things like interest on loans that are coming due, that are not yet due. Additionally, we see some financial notes, such as notes payable and short-term bank debt, that are all within the current liabilities. We also see in there long-term liabilities, which would include instruments that might include debt such as bonds or mortgages against property. Now, another element in liabilities is the equity. All right, this is the ownership of the firm, or sometimes called owner equity. It's capital. It's the money that organizations have put into the firm. And it also includes the retained earnings. So when a company generates a profit, that profit goes from the income statement. That's the amount of money that goes into retained earnings. So we also have, as what I mentioned earlier, what we call paid-in capital. That's basically what was received from other organizations or other individuals, parties, to fund the firm. Let's talk about key points. Well, the income statement provides a summary of the flows in and out of the firm over a particular period in time. The net difference between the revenue and expense, of course, is the profit or the loss of the firm. The balance sheet, in contrast, provides only a snapshot of the assets and the obligations or the liabilities of the firm at a single moment in time. When we pair the income statement with the balance sheet, we take the balance sheet date as of the last date of the income statement. All right? And then together, the income statement and the balance sheet provide a basic but not a complete understanding of the performance of the firm. If you have any questions, comments, or suggestions, please use the discussion area, and I look forward to seeing you in the next session.